You can chase bigger gains in the Nasdaq-100, an index of 100 big tech-heavy stocks. Then you watch it fall nearly 80%, and you quit at the bottom. Here's the trap. Beating the S&P 500, an index of 500 large US companies, on paper can feel worse in real life. Not because the index is breaking. Not because you picked badly. It's because brutal drawdowns, long stretches where your account keeps losing value, break people before the comeback arrives. Your foot lands on a stair that suddenly dips. Your stomach jumps. Both staircases reach the same roof. One gets there with steady steps. The other climbs faster. But every few seconds it jerks, rattles, and makes you grab the rail. That second staircase is how higher return markets often behave. The Nasdaq-100, a group of 100 big tech-heavy stocks, has historically climbed more than the S&P 500, a group of 500 large US companies, over long stretches. But the ride is rougher. The gains come with harder drops, longer recoveries, and more moments where you feel stupid for staying on. Now bring that feeling to your phone screen. It's 8:17 a.m. You open your broker app in the break room. Last month your account hit a new high. Today the line is deep red. You haven't done anything wrong. You're just living through a drawdown, the peak to valley loss on your account during a losing streak. And those violent swings around the bigger upward path have a name too. Variance. The normal swings you can't avoid, even with perfect play. That's the part beginners miss. They think a good choice should feel good most of the time. It usually doesn't. A strong long-term path can feel awful week to week. Here's why it works. Two people can pick solid funds, get similar long-run results, and have totally different experiences. The smooth staircase lets you keep walking. The jagged one makes you question every step. Same destination, different stress. Trading works the same way. A good trader can follow a plan, take smart risks, and still lose money for 3 weeks. Not because the plan failed, because the path between here and eventually right is bumpy enough to shake you out early. The real battle isn't finding the line with the best average. It's picking the path you can actually stay on. If this reframe helps, subscribe. 2 of these a week. And once you see that, the next question gets practical. What exactly makes one index so much rougher than the other? Open your app at 9:12 p.m. Both funds can look identical. 2 blue lines going up. But under those lines sit very different piles of companies. The S&P 500 spreads you across 500 big US businesses, banks, healthcare, energy, consumer brands. It's broad by design. The Nasdaq-100 is narrower. It leaves out financial companies. Then it leans hard toward giant tech and internet names like Apple, Microsoft, Nvidia, Amazon, and Meta. So when that part of the market runs, the Nasdaq-100 often runs faster. That sounds great until the mood flips. What's interesting, if a lot of your money sits in one neighborhood, you get more exposure. How much of your account is at risk to that neighborhood's bad days? In plain English, one cold season hits your whole wardrobe. That's why people get surprised. They think they hold the whole market. Really, they hold a basket with a strong personality. And that matters beyond investing. Maybe you hold 4 different stocks, and all 4 are fast-growing tech names. They look separate on the screen. Then one ugly week proves they were one bet. Traders call these your positions, the trades you currently hold. So before you judge returns, ask a simpler question. What's inside the basket, and how much of it tends to move as a pack? Once you see the ingredients, the next question asks itself. If 2 paths can end in similar gains, how much extra pain does the rougher one demand? Which would keep you up at night? Slower gains, or a 45% hole? Put $10,000 into 2 simple index funds, baskets of many stocks bundled together. Fast forward 10 years, in one version, your balance climbs in a fairly boring line. In the other, it jumps ahead, scares you, then rips higher again. By the end, both did fine. Maybe the rougher one even finished ahead. But your life is lived in the middle, not at the ending screenshot. That middle is where people quit. Your account falls from $20,000 to $12,000. Your phone shows red for 3 straight months. You start wondering if you picked the wrong thing, even if the long-term story is still intact. That deep drop has a name. Drawdown, the peak to valley loss on your account during a losing streak. And the constant lurching along the way has a name too. Variance. Now put those 2 ideas together. A tech-heavy basket like the Nasdaq-100 has often offered higher upside. It also tends to swing harder because more of the basket moves together. A broader basket like the S&P 500 still moves, but it usually spreads the pain across more kinds of companies. That means 2 paths can deliver similar long-run wealth while demanding very different stomachs. One path asks for patience. The other asks for patience while your account looks broken. The pattern is clear. This is the part beginners miss. They think the best choice is the line with the highest average return. But the better question is simpler. Can you actually stay in that line when it turns ugly? Because if a 35% drop makes you bail out, the higher return path stops being your path. On paper, it was the winner. In real life, you never got the ending. Poker players learn this fast. A strong player can make the right decision and still lose 5 nights in a row. That's not proof the strategy failed, it's proof the road has bumps. Trading works the same way. Even good traders can lose money for weeks without doing anything stupid. So the real comparison is not just return versus return, it's return versus behavior. Can you hold on through the rough parts, or will the rough parts change what you do? And once you ask that honestly, one old market crash becomes the perfect stress test. Because one famous index didn't just dip, it fell almost 80%. It's the same edge a poker player has in the table, the discipline to fold a tempting hand when the members turn, and the nerve not to tilt after one bad beat. March 24, 2000. Your coffee is cooling on the desk. CNBC is loud. Tech feels unstoppable. The Nasdaq-100, an index tracking 100 big non-financial companies, had just ripped to a record high near 4,816. Internet companies were everywhere. New chat rooms, new tickers, new reasons this time was supposed to be different. Now put yourself in an everyday version of that moment. You pick the faster horse. Not because you're reckless. The recent numbers look better. The stories are everywhere. The broad market feels slow. Then the floor drops. Over the next 31 months, the Nasdaq-100 didn't just dip. By October 9, 2002, it had crashed to roughly 795. That's about an 83% drawdown, the peak to valley loss on your account during a losing streak. The S&P 500 got hit too. Nothing like that though. Pause on what 83% really means. If something falls 10%, you need about 11% to get back. Annoying but manageable. If it falls 50%, you need 100% just to break even. If it falls 83%, you need almost 500% to recover. That's the gut punch. Higher return stories sound fun on the way up. Recovery math gets vicious on the way down. And the timeline matters. This wasn't one ugly afternoon. It was month after month. You'd get rallies that made you think the worst was over. Then another leg down. Then another. Calendar pages kept flipping. For the broader Nasdaq composite, the old March 2000 peak wasn't fully recovered until 2015. Think about that. 15 years just to see the old high again. Now bring it back to behavior. Say you checked your account after the first big drop. You tell yourself you're fine. After the second, you feel sick. After the third, you stop reading headlines. Every headline feels personal. This is where good plans break. Not because the asset was bad. Not because the long-term idea was nonsense. Because the pain lasted longer than your confidence. That's the trading lesson hiding inside the crash. A setup can still have an edge, and still punish you for weeks, months, even years. In poker, that's variance. In markets, it feels like being wrong for a very long time, even when the bigger idea eventually survives. And once that pain crosses your personal threshold, people change. They cut at the bottom. They jump to something safer after the damage is done. Or they come back late, after the recovery already happened. So the real mistake isn't picking the bumpier path. It's picking a path your stomach can't handle. Here's why it works. Higher returns is incomplete information. You also need to ask 3 plain questions. How deep can this thing fall? And what will you probably do when both happen at once? Because if your honest answer is, I'd bail halfway through, then the higher return choice was never really your choice at all. And that leads to the rule that matters most. How do you test in advance whether a drawdown actually fits you? I can handle it. Then your account drops 28% in 5 months. Well, stop opening the app. Every green day feels fake. That pain has a name, drawdown. And there's a rule for dealing with it. It's the Drawdown Fit Test. If this is useful, subscribe. More like this twice a week. 3 questions. No spreadsheet needed. First, size. What percentage drop can you watch without changing your plan? Not your brave answer. Your honest one. If a 15% slide already makes you panic, a fund or index that regularly drops 30% to 50% does not fit you. Second, time. How long can you stay with it while nothing feels better? A week sounds easy. 3 years feels different. The Nasdaq has had stretches where recovery took a long time. If your patience runs out in 6 months, your plan is mismatched. Third, behavior. What will you actually do during the fall? Add money, hold steady, or bail? Pick one now. What's interesting, in the middle of a crash, your brain gets loud. That is the test. Size, time, behavior. If your answers don't match the ride, pick a smoother ride, or take less exposure. How much of your account is at risk on a trade? The best choice on paper becomes the worst choice the moment you can't stick with it. And once you know you're fit, the next question gets sharper. How do you set it up before the pain starts? Before your next entry, the moment you buy or sell, do one simple thing. Write down the biggest drop you can actually live through. Then size the trade to that number. That habit beats guessing which index or setup will win next. Want more plain English rules like that in your feed every week? Subscribe. Next time I'll show you why the best looking chart can be the worst trade for your nerves.